Well, good morning and happy Monday to all of you. Sorry we missed each other last week. I was traveling to Colorado Springs. Lenders One, which is an internal industry co-op, had a executive roundtable that I was lucky enough to get invited to, and that was a great experience. But we're back at it again here this week, so let's jump in and let me show you what's going on. So, as always, we're going to start out with the gas prices. Guys, I don't know what else to report other than the fact that this war is apparently on again. They've been bombing each other back and forth here for the last couple of weeks. As of this morning, they have agreed to stop bombing each other, so not sure where this is all going to end up. We have seen a little bit of gas price improvement at the pump. Unfortunately, as of today versus a couple of weeks ago, as you can see there on the bottom right, WTI went from $77 over the last 2 weeks to 82, and Brent went from 82 to 89. So oil prices are up. Mortgage prices, mortgage bonds, mortgage rates are very, very much so intertwined with oil price as a result of how inflationary oil prices can be, and mortgage-backed securities hate inflation. We'll talk about that in a second, but that's where we're at here now. What's going on over here for this week? I thought it was important for us to mention a couple things. So take a look at what's happened since June 29th. This is mortgage-backed securities have lost so much ground, and that's why you'll see that the rates are higher than they were before. Obviously, it's a works inverse of this chart here. As mortgage-backed securities lose ground, rates go up. The other thing that we need to keep our eye on is I've posted the highest levels of the 10-year Treasury here on the left-hand side. It used to be 4.59. Now it was 4.61 a couple weeks ago. Now, as of today, it's sitting at 4.64. So what does that mean to you? Well, a couple different things. On Tuesday, the Federal Reserve will kick off a two-day meeting on Tuesday and Wednesday. Chances are that they're not going to increase the Fed funds rate. A lot of times when they see inflation that is sticky like it is, they may go in there and increase the Fed funds rate. Now, what this would do, this would slow down spending and allow the economy to slow down some. I don't see Kevin Warsh doing that. So what's important here is on Thursday, the personal consumption expenditure for June is going to be released. Now, what is that? That is the Federal Reserve's favorite way of measuring inflation. And remember now, it's from June. It's going to be right in the middle of kind of the reverberations of things being okay before they got worse again. So this information is going to be lagging. You're going to want to keep that in mind. Quarter two, gross domestic product, how much have we produced as a country, is going to be released. By the way, if you saw from last week's Instagram, for the very first time since the 1940s, how much we owe exceeded how much we produce, which is not a good sign. On Friday, we're going to get employment cost index to see what employers are paying their employees, and that'll be revealing as well. As always, you do want to follow us on the Instagram account. Every day we post 20, 30-second updates about what's happening with rates and what's moving the market. So if you're interested in this stuff, definitely click subscribe on there. All right. Speaking of rates, 6.72 on the 13th when we connected with you last. Today, 6.81. Jumbos are sort of getting a little bit closer to that 7 percentile mark. Remember, these are rates for folks with credit scores over 780 with 25% down in purchase loans. So definitely you want to visit with your preferred loan officer to see what he or she has to say about your situation. Okay? All right. With that, I bid you a wonderful week. Please do hit all my buttons, subscribe, like, comment, share, do all the things to make you smarter, and we'll catch you on the next one and see you on the Instagram account, okay? Take good care. Bye-bye.